Ah, the stock market. An honest place of commerce where the common man has the opportunity to create generational wealth.
Right now, the Dow is down about 900 points.
Plunging, extending a slide that has wiped out nearly $6 trillion.
Fear of a global recession. Those fears are alarming investors here in the United States.
Whoa, what's that? You said trillions of dollars worth of investments just vanished within days? Well, shit. Ladies and gentlemen, it's time to break down the stock market from the perspective of an idiot, which, well, is me. The stock market is where fools like you and I can go to buy little pieces of companies in hopes that their value will increase over time and we can sell those little pieces for a profit or a crippling loss. I wouldn't know anything about that, I swear. The value of all of those little pieces or shares put together tells you the total value of a company. For example, shares of Microsoft currently trade for $364 a piece. And there are 7,434,000,000 shares outstanding or in existence. So 7.4 billion shares times $364 each means Microsoft as a company is valued at $2.7 trillion. Now that $2.7 trillion figure is called the market cap. Now, does that mean Microsoft just has $2.7 trillion chilling in a vault somewhere? Absolutely not. In fact, that would probably be really dangerous if they did. $2.7 trillion is just what we, the masses, armed with our Robinhood and Reddit and probably a little bit of delusion as well, think Microsoft is worth. The stock market is kind of one big hallucination, sort of. Except instead of mushrooms, we're high on optimism and a lot of caffeine, baby. From here, the stock market can get a little complicated, so let's just speed fire. Where does the money you spend investing in stocks actually go? The answer, like all great things in life, is it depends. If you buy a stock during its initial public offering or IPO, that is when the company first goes public on the stock market. By the way, going public means a company is putting up some of their shares for sale to the public. That money would go to the company itself because they are selling a stake in their own company to the masses. But that only happens once. Once the IPO is done, now those shares are just sort of out in existence for people to buy and sell secondhand. But occasionally companies will issue more shares if they need some cash. What about when you sell a stock? Where does that money go? When you sell a stock, you're not actually cashing out from the company itself. You're actually cashing out to someone else who is buying the stock from you because they think they're getting a good deal. That buyer could be another retail trader, basically the average chumps like you and I who account for about 20% of the trades on the New York Stock Exchange. An institutional investor, like a giant hedge fund or a mutual fund that account for about 80% of the volume of the trades on the New York Stock Exchange. Or a market maker, a person or a company who is always ready to buy and sell stock in a certain company to keep liquidity high, trades flowing, so there's always somebody on the other side of your trade. Just like that, the cycle of delusion continues. All right, well, who actually facilitates the buying and selling? That would be the stock exchanges that the companies are listed on, like the New York Stock Exchange and the NASDAQ, both in New York. Think about it kind of like selling your Tesla shares on eBay for somebody else to buy from you. The New York Stock Exchange or the NASDAQ or whatever exchange it is kind of like eBay. The New York Stock Exchange is the largest in the world with a $28.3 trillion market cap. So how does the price of a stock actually change? The answer is as simple yet as horribly complicated as supply and demand. The price you see on a stock, whether it's $364 or $3.64, is just the price that the last trade executed happened at. Whenever a buyer's bid matches a seller's ask, a trade happens, and when that trade happens, the price of that trade becomes the new price of the stock. If I want to sell a stock for $10 and you want to buy a stock for $10, well then congrats, we just set the new stock price. More buyers than sellers, price goes up. More sellers than buyers, price goes down. All right, so what actually changes that demand? Ready for this one? You're gonna love this. We don't know. Literally anything. Apple made a ton of money, price goes up. Nvidia also made a ton of money, but it wasn't quite exactly what everybody somewhat unrealistically thought it would be, but it was still a lot of money. Price goes down, I guess. Federal Reserve cuts interest rate, price goes up. Elon Musk tweets something, price goes down. Probably. Donald Trump edges the entire world with tariffs. Price does that. Stock prices move based on news, emotions, speculation, and just pure uncut chaos sometimes. In theory, stock prices reflect a company's performance and future potential. In reality, it's part logic, part vibes, and mostly a monkey throwing darts at a board. Which brings me to bull markets and bear markets, the yin and the yang of the stock market. Bull markets are when stock prices are rising, the sky is blue, and everybody can take a dive in their money vault pools. Bear markets, on the other hand, are the exact opposite. When stock prices fall 20% from their recent highs, and we've got Wall Street Albert Einstein over here with his mouth wide open, basking in a glow of red, we, my friends, have entered a bear market. This is when shit is kind of beginning to hit the fan. again, and the euphoria that fueled the market growth in the past is kind of dead. Now, they say bull and bear market because bulls attack upward. Like that. And bears attack downward like this. Who came up with that? It's beyond me. I don't know. And this, my friends, is where things get very interesting, because in the stock market, fear and greed are the two driving forces behind every single trade. Enter the CNN Fear and Greed Index, a magical little scale that tries to sum up all of our emotions in one neat little package. If the index is showing extreme greed, then there's probably a lot of optimism and things are going pretty well. If the index is showing extreme fear, well, I mean, this is what it's looking like right now. So, you know, make of that what you will. All right. Now that we know all about emotions, prices, and buying and selling, it's time to, well, buy and sell. It turns out there are a lot of different kinds of buying and selling you can do on this little Robinhood video game. First of all, and most obviously, you can just buy individual stocks. A share of McDonald's, a share of JP Morgan, a share of Pinduoduo, whatever that is. Now, one thing you might notice when you're buying individual shares of stocks is that some of them are stupid expensive. Like one share of Berkshire Hathaway Class A, that's gonna run you $784,000. No, that's not a typo. That's a house. Several of them, maybe. So how do regular people invest in stuff like that? This is where stock splits and fractional shares come in. A stock split is when a company takes one big expensive share and breaks it down into a bunch of little, smaller, less expensive shares without changing the overall value. So if a stock is worth $1,000 and they do what's called a 10-for-1 split, that one share will become 10 shares worth $100 each. It's like cutting a pizza into more slices. You're not actually getting more pizza. It's just easier to share it with your friends if you have some. Hopefully, I don't have anyone to share pizza with. On the flip side, a lot of brokerages like Robinhood now let you buy fractional shares, which are pieces of the share. You don't have to buy the whole share all at once. You can buy a tenth of a share, half of a share, a 1/1,000,000th of a share. So if I'm on Robinhood with $100 to my name, I can't buy a full Apple share. I can buy half of an Apple share. By the way, if you want to get started investing and get a free stock, you can use my Robinhood affiliate link in the description below. No, I'm sadly not sponsored, but when you sign up, you and I will both get some free stock worth between $5 and $200. So it's kind of a win-win. The link is in the description. Overall, the individual stock picking strategy will give you total control over what you're buying. It's higher risk, possibly higher reward. And risk and reward is where the age-old value versus growth stock debate comes in. Generally speaking, tech stocks like Apple, Meta, Google, these companies are more volatile than, say, Ford, McDonald's, JP Morgan. Those tech stocks would be considered more growth stocks, while the other ones would probably be more considered as value stocks. And choosing a variety of different kinds of stocks in different sectors like financials, consumer goods, healthcare, tech, etc. is called diversification. And it's a great way to make sure you don't go broke overnight. This is not financial advice, by the way, don't sue me. Or you could always just go the throw all your eggs in the military-industrial complex basket route and spend your entire paycheck on some good old Lockheed Martin stock. If we're gonna annihilate a patch of desert in the middle of nowhere, you might as well make a couple of bucks. Right? Another thing to note is that some companies pay what are called dividends to their shareholders. And dividends are a little payment that you, as an investor, get just for owning the stock. For example, Coca-Cola has a dividend yield of 2.87%, meaning that if I invested $100 into Coca-Cola, I can expect to make about $2.87 a year in dividends. And you can actually choose to automatically reinvest those dividends back into Coca-Cola through DRIP or a dividend reinvestment plan. Or you can, I don't know, just take the cash. The dividend yield, by the way, is calculated by dividing the amount of dividends you'll get paid in a year by the company's stock price. So if Coca-Cola pays $2.04 per share annually and their stock price is $70.91, the dividend yield is 2.87%. But since the yield is just the ratio of the dividend compared to the stock price, if the stock price goes up, the dividend yield will go down. The dividend yield is dependent on the stock price. Now, these dividends typically come from company profits, but not all companies pay dividends. Many companies, especially high growth ones, may prefer to reinvest their earnings into the business rather than paying out dividends. And as a general rule of thumb, companies that pay out higher dividends, or even just dividends at all, tend to have less explosive stock price growth. Now, this isn't always true, but it's generally the case. For example, you don't really see a lot of tech companies paying out dividends, and if they do, like Apple and Nvidia, they're usually really small. And among the companies that do pay out dividends to their shareholders, most of them pay them 4 times a year or quarterly. Some will pay them monthly, semi-annually, or even all at once annually, but that is a lot less common. Now, individual stocks are a pretty popular way to go, but the truth is, over 70% of DIY investors lose money. Now, let me let you in on a little secret here. Come close. you are an idiot who knows nothing. No matter how much you think you know about stocks, chances are you're probably stupid like me. That's why my favorite thing to invest in, and no, this is not financial advice, are exchange-traded funds, or ETFs. Basically put, ETFs are a bunch of different stocks bundled together in a little basket that you can buy all at once. So instead of me going out myself and buying one share of Apple and Meta and Google and Tesla and managing all of that together, I can instead go out and buy one share of Invesco QQQ, for example, which is an ETF that bundles together a bunch of tech stocks. When I, again, for example, buy QQQ, I'm not just getting Apple, I'm getting a little slice of Microsoft, and a little slice of Nvidia, a little slice of Amazon, and a little slice of Meta, and a bunch of other heavy hitters all in one shot. The reason I prefer this method is because it's less risky. Instead of my dumb ass trying to pick which stocks to hold, I can go out and get all of the largest tech companies together, and I don't really have to think twice about it. If Apple stock randomly plummets because iPhones start exploding for some reason, I won't really be too affected because I have other companies in this ETF that are holding it up. ETFs are basically lower risk, possibly lower reward in comparison to buying individual stocks. And, fun fact, account for about 32% of the total dollar volume of stock market trading in the US. This is why a lot of people use ETFs in their retirement accounts like their Roth or 401k, because you're not really planning on selling anything for decades, and it's better to have something that is lower risk when you're doing that kind of longevity. Or maybe we'll just work like dogs for 40 years chasing a donut on a string until Social Security collapses and we never retire. Anyway, another option are index funds, which are pretty similar to ETFs, like Coke Zero and Diet Coke. I still don't know the difference between the two, but they kill my kidneys the same as far as I'm concerned. ETFs and index funds are both baskets of stocks. They both give you instant diversification, and they both let you ride the wave of the overall market without you pretending that you're Warren Buffett Jr. I would know. I have tried. While ETFs trade exactly like stocks, index funds can only be bought and sold once a day at the end of the trading day. So you want to panic sell everything when the market opens and tanks? Too bad. It's hyperventilating in a paper bag for you, my over-emotional friend. Now, a lot of the time, you're going to hear terms like the S&P 500 and the NASDAQ Composite and the Dow Jones thrown around. What are those? Each of those are called indexes. Indexes are things you can't buy into directly, but you can buy an ETF or an index fund that closely mimics those indexes. For example, the S&P 500 is an index, and it is literally just a list of the 500 largest companies that are traded in the US. Now, if I wanted to, I could buy VOO, an ETF that, according to Vanguard, seeks to track the performance of the S&P 500 index. On top of that, people also try to make money with mutual funds and options trading and short selling, but we're not going to get into all of that today because those are complicated and scary, and I don't really want to break down into tears on camera today. Alright, so now that you know all about how to throw your money into the market like a somewhat informed lunatic, let's talk about why people actually do this. I want to show you the magic of the stock market today because chances are, if you're new to investing or you're young like me, you've never really thought about this before. Because the stock market is incredibly powerful. This is not financial advice, though, legally. Okay. Over the last 20 years, the companies of the S&P 500 have returned investors an average of 9% per year. Some years in that time were a lot more than 9%, and other years were a lot less. Check out how this might work out for you if you were to invest $10,000 today, assuming we keep that same average 9% annual growth rate. After 1 year, you would have $10,900. After 5 years, you would have $15,386.24. After a decade, you would have $23,673.64. And after 20 years, for you doing absolutely nothing, that $10,000 would turn into $56,044.11. Again, these returns aren't 100% guaranteed, but as a general rule of thumb, assuming you don't buy companies, the longer you keep your money in the market, the lower the risk of you losing money becomes. This growth is called compound interest, aka interest on interest, aka your money doing little push-ups in the background while you eat, sleep, hang out with your friends, watch me pollute the internet with my content, literally anything. It's like your money had babies, and those money babies grew up and had money babies of their own. Kinda. We'll go with that. Now imagine, just for a second, that you invested this $10,000 at age 20 and decided, I'm just going to let it sit there till I'm 60. I'm not going to touch it. After 40 years, your $10,000, again, for doing absolutely no work whatsoever, would become $314,094.20 with a 9% annual return rate. This is where the importance of starting early becomes super obvious. Holy shit, I sound like my dad. Now let's make things even more fun. Let's assume that on top of that initial $10,000 you put in, you want to contribute an extra $100 a month. After 40 years, that $314,000 would instead be $739,059.05. If we bumped it up to $200 a month, you would have well over $1.1 million. Obviously, this takes a lot of time, but these are things that you seriously and realistically could consider doing, especially if you're a college student like myself. Right now, watching this video, you are the youngest you will ever be again in your life. Think about what you could do right now. There will be ups and downs, and sometimes those downs feel crushing. But if you stay consistent, ride the wave, and believe that the economy of what is pretty much the most entrepreneurial, innovative country in the world will continue to grow over the next 20 or however many years as it has in the past, you're gonna do just fine. If you haven't started investing yet, again, you can use my Robinhood affiliate link down below to get started today. They're not paying me to say this, I promise I'm not sponsored, but I've been using Robinhood myself for a while now, and when you sign up today, we'll both get between $5 and $200 worth of free stock, so it is a win-win. But anyway, the importance of riding the ups and downs of the stock market seriously cannot be overstated. Take a look at the Dow Jones Index back when COVID struck. To put it lightly, investors were scared shitless. The Dow fell 33%. People couldn't go to work, students couldn't go to school, people were locked up in their homes for months, stuck watching the damn Tiger Dude and Charlie D'Amelio do whatever she did back then. What does she even do nowadays? Does anyone know where she went? It was a mess. Anyway, the point is, if you held your money in the stock market back then and didn't sell when everything looked catastrophically horrible, everything going to hell, that dip you felt in 2020 today would just be a little bump in the road. You would hardly even notice it. But if you did sell when the markets tanked, your money would in fact just be gone. Same goes for the even more devastating 2008 financial crisis. Entire banks collapsed, people lost their homes, and if you think a 33% dip in the Dow in 2020 was bad, it fell about 50% during the 2008 financial crisis. But the same thing is true. If you didn't sell your stocks back then, you would be just fine today. And nowadays, when we're talking about the T word, actually both of the T words together,
we're gonna win so much, you may even get tired of winning, and you'll say, please, please, it's too much winning.
You might be a little scared. You might be watching everyone on the news talking about how the world is exploding and it's, oh no! The world is ending. McDonald's ice cream machines are going to start working again. You know, everything's just totally backwards. But again, if you just look at the charts, this will just be another bump in the road. And even if it falls more than it already has, it could just be a nice time to buy more stock at a discounted rate. It's like when you find a really cool shirt in the clearance aisle and think, how did nobody want this? Except instead of some button-up floral shirt, it is in fact a $2.7 trillion tech giant like Nvidia. Now, that is just one way to look at it. If you want to think short term and panic, that's on you. You can do that. All right, so you've decided you want to invest. You stopped buying McDonald's and coffee every morning and saved up a good chunk of change. $10, $100, $1,000, $10,000, whatever it is. You want to get started? Where should you go to do this? That is where brokerages come in. Brokerages are those fun apps we download to buy and sell our stocks. You've maybe heard of Robinhood or Webull or TD Ameritrade before. These are all brokerages. They're all a little different, but they all let you do basically the same thing. Open an account, deposit some money, and start investing. A brokerage is basically just the middleman between you and the stock market. Unfortunately, you don't get to walk in on Wall Street with a wad of cash and scream, "Put it all on Tesla!" like it's a casino. You don't get to do that. I'm sorry. Instead, you use a brokerage app to place your trades, and they handle all of the complicated stuff behind the scenes. Nowadays, a lot of brokerages don't charge you commissions for every single trade that you make like they used to. So that naturally begs the question, how do brokerages actually make their money then? There are a few ways, including payment for order flow, which is basically when you place a trade, your brokerage will route it to a big Wall Street firm called a market maker. We talked a little bit about those earlier. For example, say Citadel Securities, they're a big one, who executes the trade and then pays the brokerage a small fee for the business. It's like if you wanted to buy a soda and your friend was like, "I'll go grab it for you," and then your friend quietly collected like 2 cents from the vending machine just for doing it. A common critique of payment for order flow is that it can incentivize brokerages to route your trade to the firm that offers the biggest payment to the brokerage rather than to the firm that would execute your trade the fastest. In other words, your trade might just go to the highest bidder, if you will, rather than the one that does the best job. But on the other side, people have argued that payment for order flow has completely revolutionized investing, bringing it to the common person because you no longer need to pay a hefty commission. Brokerages like Robinhood also make money from margin accounts, which basically involves you borrowing money to invest. Obviously, that's pretty risky though, so maybe leave that to the big guys, I don't know. They also have premium memberships like Robinhood's Robinhood Gold, and make interest on the uninvested cash that just sits in your account. Now, wherever you park your money, whether that's a bank or a brokerage or some dude with a pyramid scheme, you want to make sure that your account is, I just got a text message, is insured. Lucky for you, the federal government will protect your money up to a certain amount if your bank or brokerage goes kaput. If it's a bank, that means FDIC insurance, which covers up to $250,000 if the bank fails. If it's a brokerage like Robinhood, Fidelity, or any of the others, that means SIPC insurance, which will cover up to $500,000. Of course, SIPC protection doesn't cover, losses. So if you invested in Peloton at $160, that one's on you, buddy. And now for everybody's favorite part of investing and just life, frankly, taxes. Hot diddly dog! So you've made some money in the stock market. Congrats. Now it's the IRS's turn. Sell a stock for profit, that's a capital gain, and it's taxable. Sell it in under a year after you bought it, that's a short-term gain, and it's taxed like income. Hold it for over a year, and that's a long-term capital gain, and it's usually taxed less. Long-term capital gains taxes are determined by your marital status and your income. So if you're gonna make money, maybe do it slowly. The IRS rewards patience, weirdly enough. There is a way around taxes, though. If you invest in a retirement account like a Roth IRA or a 401k, you can delay or even avoid paying those taxes altogether. So if you want to start building generational wealth today, or at least, start the process of not being broke forever, you can sign up for Robinhood for free with the affiliate link I have in the description below. I'll say it once again, you can get a stock worth between $5 and $200, and more importantly, the chance to play the game. Well, my friend, I hope you learned a thing or two about the stock market today with my incredibly simplified explanation. If you want to watch me yap about the ins and outs of cruise ships for 20 minutes, I know, kind of random, but it's a good video. You can click here, or somewhere on the screen. Be sure to join our first 100,000 legends before it's too late, and until next time, goodbye.